Welcome back. Earlier today, this morning, consumer price index was released. For the most part, in line. But what we're going to see is there's an ongoing trend where the producer prices are rising more than the consumer prices. The red line shows us the increase in producer prices versus consumer prices. We're going to dive into that in just a moment. We see here on a month over month basis in yellow 0.4% to the upside. That's consumer price index. Core CPI up 0.3. Core CPI excludes food and energy, which are considered to be more volatile components. On a year-over-year basis, CPI up 3.7% year-over-year, core CPI up 4.1%. So on a year-over-year basis, excluding food and energy, consumer prices are actually rising more. And that really flies in the face of a lot of analysts which say energy was the only reason why we still have inflation. Here we see CPI on the left-hand side. This is all measured on a year-over-year basis, up 3.7%. Core CPI, excluding food and energy, up 4.1%. Now, food alone is up 3.7. The energy sector is actually down 0.5, which goes to show us that it really is not energy which is driving the inflation. It's energy and a lot of other things, which again is what we spoke about yesterday with the PPI release. White histogram bars here show us CPI on the month over month basis, core CPI in red. Again, month over month basis. The last two reports for both measures, CPI and core CPI, are the highest highs we've seen in quite a while. In particular, notice the month over month CPI. This is the highest reading going back to May of last year. This is over a 1 year high month over month basis for CPI. So inflation is still very much, on the rise. Here we see in red CPI food only and yellow is energy only. And we can see both measures have pretty much returned towards the center. This is on a year-over-year basis, no remarkable moves. So it really goes to show us that, again, inflation, it's not just at the supermarket, it's not just at the gas station. Here's CPI in yellow year over year versus the red, which is core CPI. And remember, again, we have a 2% Federal Reserve target. We want to see a sustained inflation level close to this or below, hopefully, the 2% level. We did come down on the CPI a few months ago, about May of this year, but then we bounced back up. A lot of analysts attribute that to, well, energy prices. But the fact of the matter is, although the red line is pointing lower, it's still very much ahead or above our 2% targets. We see here CPI on a year-over-year basis versus red, which is crude oil. Pretty strong correlation. When crude oil goes up, so does the inflation number. And when crude oil goes down, so does inflation as well. But the CPI is not only crude oil. Here's crude oil versus the only energy component of CPI. This is the energy sector within CPI. Very close correlation. As energy prices go up, certainly the consumer price index in this region also goes up. We see here CPI food in red, CPI yellow in energy. This is on a year-over-year basis. Again, they've come back right towards the center. There's actually, ironically, not a big move lately in food or energy, at least in the grand scheme of things. Here's in yellow CPI year over year versus the S&P 500. Now, typically we expect to see a positive correlation. Typically, we expect to see that when the economy is better, inflation goes up, for good reasons, because we're making more money, we're spending more money, and then the consumer price index goes up. But lately, very oddly, the stock market has really kind of held its ground, relatively speaking, compared to the CPI. But there's certainly a lot of people who think that's going to change. Here we see, now this is PPI minus CPI, and I think this is the real takeaway. The white line is the S&P 500. PPI is producer price index. That measures the cost of goods and services at the wholesale level. That's what the factories pay for the raw materials. Consumer price index is what we pay at the store for milk and gasoline and shoes and apparel and everything else. Now, we can see overall there's a positive correlation. When the producer price index goes up more than the consumer price index, well, the S&P 500 tends to go up. Why this occurs? Well, it's anybody's guess. But the fact of the matter is, it's assumed that the producer prices, if the manufacturers have to pay more money, spend more money for raw goods and raw materials, they will eventually pass on those higher costs to us, and then it will normalize, meaning the PPI will go up first, and then the CPI will follow. What's happened lately is this line has really come to the downside, not because PPI has come down, but CPI has gone up. Now we see the reverse taking place. Producer prices are going back to the upside. After all, we saw a PPI number yesterday. I think it was a little bit stronger than today's CPI number. Today's CPI number was in line, 3.7%. So when this line goes up, we can extrapolate from this historically that the S&P 500, the stock market will move in similar fashion, meaning when this line goes up, the white line will go up also. Now, there's a Federal Reserve speaker, I believe it was Bostic, a couple months ago that did say that one of the major concerns of the Federal Reserve is the fact that the producers, their profit margins being squeezed. The producer prices are going up more than the consumer prices. They said this at this point when this red line was going up, and that really was a case. That shows us the producers were going up. Now, this is not necessarily a good phenomenon because you think about it from a corporate point of view, producer prices are going up, but they can't pass on the extra cost to the consumer. What does that mean? It squeezes the profit margins for the companies, which are reflected in, earnings and stock market prices. So we don't want to necessarily see, as much as we, the consumer, want to, get better prices. We don't want the producers for the profit margins to be squeezed because then our stock investments go down. So, we hope that it reaches some sort of normalcy, maybe a steady line in the middle. But at the moment, we're seeing a return back to the upside where the producers are paying more than consumers. Generally, again, there's a positive correlation. Stocks should bode well. At least, that's what the data suggests. But it'll be left to be seen. We hope this has been helpful. We look forward to seeing you back soon.